So you're ready to buy gold to protect your wealth.
That's a smart move.
But hold on, because there's a good chance you're about to fall for one of 7 expensive traps that plague new investors. A lot of people who buy gold for the first time lose money before they even start, all because of hidden fees and bad advice. In a world of stubborn inflation, shaky markets, and non-stop geopolitical drama, owning a real, tangible asset that has held its value for thousands of years just makes sense. Central banks are continuing to buy it by the ton, and after soaring to historic highs in 2024, prices have stayed strong in 2025, with some analysts seeing even higher prices on the horizon. But this rush into gold has created a minefield for anyone who isn't prepared. The internet is flooded with slick salesmen and deals that are just too good to be true. In this video, I'm going to walk you through these 7 costly mistakes so you can invest with confidence and avoid getting ripped off. We're going to break down the lies, the hidden fees, and the psychological traps that can turn your golden opportunity into a financial nightmare. The third mistake is one I see almost everyone make, so you'll definitely want to stick around for that. Let's get into it. Mistake number 1, paying sky-high premiums. The first, and maybe the most common mistake that will absolutely kill your returns from day one, is paying an outrageous premium. Many first-timers think the price of gold is the price of gold, simple as that. They see the spot price on the news, which as of today is hovering around $3,750 an ounce, and they figure they'll pay something close to that. But that's not how it works at all. The spot price is the wholesale rate, what dealers pay for huge bars of raw gold. When you buy a gold coin or a smaller bar, you pay the spot price plus a premium. This premium covers making the coin, shipping it, the dealer's business costs, and of course their profit. And this is where beginners get slaughtered. A fair premium for a common 1-ounce gold coin might be 3% to 6% over the spot price. But some dealers, especially the ones targeting new investors, will hit you with premiums of 15%, 30%, or even more on certain products. Where does this happen the most? With 2 kinds of products, tiny, fractional gold pieces, and so-called collectible or proof coins. Buying a 1/10 ounce gold coin is like buying a single can of Coke from a hotel minibar. You're paying a massive markup for the convenience and small size. On a per-ounce basis, you could be paying hundreds of dollars more than if you had just bought a standard 1-ounce coin. The fix here is simple, but it takes discipline. Always know the spot price before you shop, and calculate the premium as a percentage. When you're looking at a coin, take the seller's price, subtract the current spot value of the gold in it, and then divide that number by the spot value. That gives you the premium percentage. Your job as an investor is to get that number as low as humanly possible for the product you want. Compare prices between several reputable dealers. A few percentage points might not sound like a big deal, but when you're investing thousands of dollars, it adds up to a fortune. Don't start your investment journey already 15% in the hole. Mistake number 2, buying the wrong kind of gold. The second big blunder is buying the wrong type of gold for your actual goals. The gold world is basically split into a few camps. There's physical gold, like coins and bars, and then there's paper gold, like ETFs or gold mining stocks. And even within physical gold, there's a huge difference between bullion and numismatics. If you choose the wrong one, you could be setting yourself up for bad returns, a nightmare when you try to sell, and a whole lot of frustration. Let's start with paper gold. Gold ETFs are basically stocks that track the gold price. They're super easy to buy and sell through any brokerage account. The catch: you don't actually own the metal. You own a piece of paper that says you have a claim on gold held in a vault somewhere. For a lot of people, that defeats the whole purpose of owning gold, to have an asset that's completely outside the financial system. Gold mining stocks are even riskier. Their price isn't just tied to gold, it's tied to how well the company is run, whether their mines are productive, and even local politics. They can give you huge returns, but they're way more volatile than gold itself. Now for the big one in physical gold: bullion versus numismatics. Bullion coins and bars are made for investment. Their value is based almost entirely on how much gold they contain and how pure it is. Think American gold eagles, Canadian maple leafs, or just plain gold bars. They're mass-produced, recognized everywhere, and super easy to buy and sell near the spot price. Numismatic or collectible coins are a totally different animal. These are rare or historic coins whose value depends on their scarcity, condition, and what collectors are willing to pay, not just their gold content. Shady dealers love pushing these on beginners, usually with a great story about how rare they are and how they'll be worth a fortune someday. The truth is, the market for these coins is incredibly subjective and not very liquid. You might pay a 50% or 100% premium for a rare coin, only to find out when you try to sell that nobody wants it, and the best offer you can get is what the gold is worth melted down. Unless you are a serious, expert-level hobbyist, you should not be buying numismatic coins as an investment. The solution? Figure out your goal. If you want to protect your savings from inflation, stick to low-premium, common bullion coins and bars. Their value is clear, and you can sell them easily anywhere in the world. If you want the stock market experience, an ETF is fine, but just know you're giving up physical ownership. For 99% of people starting out, the answer is simple: buy bullion. Mistake number 3, falling for high-pressure sales and slick marketing. And here it is. The mistake I see more people make than any other. This is what separates smart investors from the people who end up with a story about how they lost a bunch of money. It's falling for high-pressure sales tactics and the fear-based marketing that has taken over the precious metals world. You've seen the ads. They're all over the internet and late-night TV, usually with some serious-looking guy talking about economic doom and gloom. They use trigger words like government confiscation proof, secret insider deal, or the one coin you must own before the dollar collapses. They're designed to scare you and make you feel like you have to act right now. Their goal is to get you on the phone. Once they do, a highly trained salesman will use every trick in the book to sell you their overpriced, supposedly exclusive coins. These companies love to push proof coins or modern commemoratives. These are the shiny coins that come in a fancy velvet box with a certificate of authenticity. The salesperson will tell you it's a limited mintage from the US Mint with amazing collector potential. What they don't tell you is that limited can mean hundreds of thousands were made, and they're selling them at an insane markup. You might pay $4,500 for a 1-ounce coin with a gold value of $3,750 that you'd be lucky to resell for $3,850 more in the open market. You just paid a huge premium for a story and a nice box. It's a great business for them and a terrible deal for you. Another classic trick is the bait and switch. They'll advertise a popular bullion coin at a great price. But when you call, they'll say, "Oh, we just ran out of those," or, "The smart money is actually moving into these other coins." And then they launch right into their pitch for the high-margin collectible stuff. The solution is to be your own best defense. First, never ever make an investment decision out of fear or urgency. If a salesman says you have to buy today, that's your signal to hang up the phone. Second, do your own homework on whatever coin they're pushing. Go to eBay or check prices with other big dealers to see what it actually sells for. You'll almost always find the real market value is way lower than their price. And finally, stick with reputable, well-known dealers who specialize in bullion. Good dealers don't need to pressure you. Their business is built on fair pricing and volume, not on tricking you into a bad deal. If you're finding this helpful and I've maybe saved you from a costly mistake, do me a favor and hit that subscribe button. My goal here is to give you clear, honest information to help you protect your wealth, and every subscription helps me reach more people just like you. Mistake number 4, ignoring the total cost of ownership. The fourth mistake is a silent portfolio killer, forgetting about the total cost of owning physical gold. Most people get fixated on the purchase price and the premium, but they forget that holding a real, physical asset comes with its own costs and responsibilities. If you don't plan for these, they can slowly eat away at your returns. The biggest one is storage. After you buy your gold, where are you going to keep it? Hiding thousands of dollars in gold under your mattress is not a plan. It's a gamble. You need a secure storage strategy. A good home safe, bolted to the floor, can cost anywhere from a few hundred to several $1,000s. That's an immediate upfront cost. A more common route is a bank safety deposit box. They're secure, but you'll pay an annual fee. More importantly, the contents of a safety deposit box are generally not insured by the bank or the FDIC. If there's a robbery, fire, or flood, you could be out of luck unless you buy your own separate insurance policy, which is another recurring cost. For larger amounts, there are third-party depositories. These are high-security private vaults that offer fully insured storage, but they charge an annual fee, usually a percentage of your holdings. But there's another hidden cost many U.S. investors forget: taxes. When you sell stocks you've held for over a year, you pay a long-term capital gains tax. But the IRS classifies physical gold as a collectible, which means your profits can be taxed at a higher rate of up to 28%. Forgetting about that 28% tax bill can lead to a nasty surprise when you decide to sell. The solution is to have a plan for all these costs before you buy. Factor in the cost of a safe or annual storage fees, insurance, and the future tax bill. Ignoring these costs is like buying a car and forgetting to budget for gas and insurance. It's a vital part of the equation for long-term success. Mistake number 5, having no exit strategy. This next mistake is incredibly common because it's all about emotion. Everyone gets excited about buying gold, but almost nobody has a clear, logical plan for selling it. They just stack it up with no real goal in mind. Then, when it's time to sell, they either do it in a panic or get a terrible price because they're totally unprepared. Not having an exit strategy is just as dangerous as overpaying in the first place. A good exit strategy has 3 parts: knowing why you'll sell, when you'll sell, and where you'll sell. First, the why. What's this gold for? Is it a long-term inheritance for your kids? A hedge against inflation that you'll cash in if things get crazy? Or a shorter-term trade? You have to define its purpose. If you don't know why you own it, you'll never know when it's the right time to let it go. Second, the when. And no, this isn't about trying to time the market perfectly. That's a fool's game. Gold is a long-term investment, not a get-rich-quick scheme. A smart strategy might be to sell a portion of your gold when it hits a certain price, or when it becomes too large a part of your overall portfolio. For example, you might decide to sell some if gold grows to more than 15% of your total net worth. This is a disciplined approach, the total opposite of panic selling on a dip or greedily holding on forever. Third, and most practical, is where. You need to know how to get a fair price when you sell. Your main options are local coin shops, pawn shops, or big online dealers. Pawn shops will almost always give you the worst price. Your best bet is usually the same big, reputable online dealers you'd buy from. They list their buyback prices right on their websites. Before you ever need to sell, you should know who these dealers are and understand their process for selling back to them. So, think through your exit plan before you even buy. Write it down. Why am I buying? When will I sell? Who will I sell to? Answering these questions will stop you from making emotional decisions and make sure you get the most for your investment. Mistake number 6, not vetting your dealer. The 6th mistake can lead to the most catastrophic losses of all: not doing your homework on the dealer you're buying from. In the gold market, who you buy from is everything. A good dealer is your partner. A shady one is a predator. The internet makes it easy to buy gold, But it also makes it easy for scammers to set up websites that look totally legitimate. The horror stories are out there. People send a bank wire for thousands of dollars to a slick-looking site offering a great deal, and then nothing. The gold never shows up and the website vanishes. Or they get a package only to find out it's a fake, a tungsten bar with a thin gold plating. By the time they figure it out, the seller is long gone. Mark Twain once said a gold mine was a hole in the ground with a liar standing next to it. Well, today that liar is often standing behind a website. So how do you protect yourself? You need a checklist for any dealer you're considering. First, look for a long track record. Has the company been in business for 10+ years? A dealer that has been around for a decade is a much safer bet than a site that just popped up last month. Second, check for professional memberships. Are they an authorized dealer for major mints, like the US Mint, or part of groups like the American Numismatic Association, ANA? Third, read online reviews, but use your head. Check independent sites like the Better Business Bureau. Look for patterns. Is everyone complaining about shipping delays or getting the wrong product? A few bad reviews happen, but a pattern of serious complaints is a huge red flag. And finally, test them. Do they have a real address and phone number? Give them a call. Ask some questions. A real dealer will be happy to talk. If they're evasive or give you a high-pressure pitch, just walk away. And if a deal looks too good to be true, like gold selling for less than the spot price, it is always a scam. Spending a couple of hours researching a dealer is the best investment you can make. It's the firewall that protects your entire stack. Mistake number 7, letting fear or greed drive your decisions. We've covered a lot of technical mistakes, but this last one is the most personal and honestly the hardest one to master. It's letting your decisions be driven by the two most powerful emotions in any market, fear and greed. When the news is all chaos and inflation, the fear of missing out, FOMO, can be overwhelming. You see the price of gold making a major run-up, and you feel this desperate urge to buy at any price before it goes even higher. This is when people throw all their rules out the window. They buy at the peak, they pay crazy premiums, and they get suckered by a good story, all because they're terrified of being left behind. The flip side is when gold has a temporary pullback, which is a normal and healthy thing for any asset. Fear can cause you to panic sell at the bottom. You forget your long-term plan and react to the noise, locking in a loss and breaking the #1 rule of investing: buy low, sell high. Greed is the other side of that dangerous coin. It's what pushes people to gamble on speculative coins, hoping for a 10-to-1 return. It's what convinces them to hold on way past their selling point, dreaming of infinite gains, only to watch a correction wipe out a huge chunk of their profit. Here's the truth: gold is not a get-rich-quick scheme. It is a long-term tool for preserving your wealth. It's insurance against your dollars buying less tomorrow than they do today. Its job is to be stable and reliable over decades, not to give you a thrill ride overnight. The solution to this emotional roller coaster is to create a simple, logical investment plan. Write it down, and then have the discipline to stick to it. Your plan should define what percentage of your portfolio you want in gold. Most experts suggest between 5% and 15%. It should define how you'll buy it, maybe by buying a little bit each month to average out the price swings. And like we talked about, it must include your reasons for selling. By committing to a rational plan, you're letting your logic lead, not your emotions. You take fear and greed out of the driver's seat and start acting like a disciplined investor, not a gambler. And that is the ultimate key to success. All right, that's the list. The 7 mistakes that cost new gold investors a fortune. From paying high premiums and buying the wrong kind of gold, to falling for sleazy marketing and letting your emotions get the best of you. Investing in gold is a smart move for anyone looking for a safe haven in this turbulent world. It's a real asset that has proven its worth for centuries. But buying it the right way takes education and discipline. By avoiding these 7 pitfalls, you can navigate the market with confidence, get a fair price, and make sure your gold actually does its job, protecting your hard-earned wealth for the long haul. Don't let a simple mistake turn your golden opportunity into a story you regret. Do your research, stick to your plan, and build your stack with confidence. Thanks for watching. If this video helped you, please give it a thumbs up, and don't forget to subscribe for more content on smart investing. Let me know in the comments which of these mistakes you found the most surprising. I'll see you in the next video.